Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. In this episode, we'll focus on nuclear energy and uranium. So we know that the war in Ukraine has accelerated the transition to alternative sources of energy, and nuclear power in particular is back in prominence because the governments all over the world are trying to tackle climate change and at the same time reducing the dependence on Russian fossil fuels. Uranium, which is used mainly in nuclear power plants, is one of the cleanest ways to produce electricity. But nuclear energy currently accounts for just 10% of the world's electricity production. We have the perfect guest to discuss this topic. I'll be joined by John Champaglia, CEO at Sprott Asset Management. Sprott offers two uranium ETFs. There's Uranium Miners ETF, the Sprott Uranium Miners ETF, ticker symbol URNM, is listed in the US. And they also offer the world's largest physically backed uranium ETF, which trades in Canada. So we'll try to cover the most interesting developments in this area, and we'll also talk about the two ETFs. Joining me now is John Champaglia. John, welcome. Great to have you on the show.
Great. Thanks for having me.
So let's start with this renewed interest in nuclear power. Do you think a new nuclear renaissance is on the horizon now, and why?
Yeah, well, that's a great lead-in because I actually just wrote a report about that a few weeks ago, and we do believe that we are at the dawn of a new renaissance. And the reason for that is because there are a number of very powerful catalysts that are shifting, I think, energy policy and perception with respect to nuclear energy. And it really started last year with COP26 and the renewed pledges for decarbonization and meeting greenhouse gas reduction targets, and having the United States rejoin the Paris Climate Accord. And I think many governments modeled out, how are they going to decarbonize their economies and how would they possibly hit these targets? And it became more and more apparent that having nuclear energy as part of your overall mix of energy generation was a critical step in order to meet those targets. So it really started with this idea of zero carbon energy production, and then more recently, and unfortunately, the invasion of Ukraine by Russia has created an energy crisis in Europe, which has further put nuclear in the spotlight because nuclear energy is a stable form of baseload power. And what I mean by that is that nuclear power plants essentially run almost continuously. The only time they go offline is when they need to refuel, which typically is 18 to 24 months. So running a nuclear power plant, you're not at the mercy of a supply shortage, such as Russia cutting you off from natural gas, or a price spike in the commodity that you're using as your fuel. So I think these two catalysts are very powerful because governments want to decarbonize their economies. Nuclear can help them do that as well. Nuclear energy can provide energy security and independence because it provides very affordable and reliable baseload power.
So let's talk about some of the recent government initiatives to support nuclear energy. And here in the US, the Inflation Reduction Act includes $30 billion in production credit to existing nuclear power plants over the next decade. And this is in addition to support provided by last year's infrastructure law. And many governments in Europe and here California here, they have announced some new steps to support nuclear energy, and in some cases they have done a U-turn on their earlier policies. They reversed their earlier policies. So could you walk us through some of the recent government initiatives in this area?
Yeah, that's a great overview. And we use that term policy U-turn when we describe what's happening right now around the world. And for many years, certain governments around the world were not supportive of nuclear energy. Some governments were actively trying to phase it out of their energy grids, like Germany, and we now see the consequences of that right now in real time, unfortunately. But governments are making these U-turn policy decisions because they need to provide stable, reliable electricity to their grids. The systems right now are taxed at times due to different weather events. So, for example, we've loaded a lot of renewable energy into the electrical grid over the last 20 to 30 years. And that's been very positive, adding wind and solar and hydroelectric. But it comes with a shortcoming, and that is intermittency. And that means that when wind is not blowing as much as your model predicts it will, or rainfall is less than normal, you have lower energy output. And so the state of California, for example, recently announced that Diablo Canyon, which is their last nuclear power plant, was scheduled to be closed in 2025. And the governor basically intervened and said, we can't close the plant. We actually need to extend its operating license out to 2030. And, within a week of that announcement, California was at risk of basically having brownouts and blackouts because its electrical grid system could not support the needs when it was quite hot a few weeks back. So you need to have this reliable baseload power offsetting the intermittency of renewables. And we're seeing this in the United States in a big way. The Inflation Reduction Act we would describe as being very, very supportive for the utilities that are operating nuclear power plants and essentially taking nuclear power plants out of the penalty box, which they've been in for many, many years, and putting them on a level playing field to other forms of energy generation. And I think that resetting gives utilities much more confidence to make long-term decisions in terms of how they run their operations. If you look around the world, a couple of big policy shifts of late. One in South Korea, new prime minister came in and said, we're not phasing out nuclear, and we're actually going to be expanding and exporting our technology in this area. And then about a month ago, the Japanese prime minister said, if we don't restart more closed nuclear power plants, we run the risk of not having enough electricity this winter. So, it's yes, everybody wants to decarbonize, but there's actually more pressing issues with respect to availability of electricity right now in some parts of the world. And that's really giving nuclear a boost.
Excellent. So I wanted to take a step back here and talk about some of the basics. And you have some excellent videos on uranium and uranium mining on your website. And I certainly encourage our listeners to watch those videos if they're interested in this area. But could you help us understand what uranium is and how uranium is mined and milled?
Well, uranium is an element. It's one of the elements in the periodic tables. It typically is in an ore body, so it can be in a rock, and it's mined in two different ways. It's in either underground mines, open pit mines, or a technique they called in situ recovery, which is essentially where they drill into the ground, they inject chemicals into the pipes, and that chemical leaches the uranium out of the stone or soil, and then they basically pump it out of the ground. The first stage of uranium is processed into something that looks like yellow powder. So that rock will then get turned into this yellow powder, which is called U3O8. And that yellow powder is fairly safe. You can handle it. It's not highly radioactive or dangerous. They eventually will process that into the end product, which is a fuel pellet. And that fuel pellet will be put into the reactor core, and that's essentially what creates the reaction, which throws off heat, and that heat is used to boil water. It's kind of like a giant a giant kettle where steam is produced. The steam turns a turbine, and that generates electricity. Yeah, and uranium is heavily produced in a small number of countries. Kazakhstan is the largest producer in the world, and that's a country next to Russia. Canada is another area with very rich uranium deposits, mostly in the province of Saskatchewan. And Australia and countries in Africa like Niger and Namibia, and as well as Uzbekistan, are the primary producers of uranium right now in the world.
Very interesting. So let's talk about uranium prices now. So these prices were, about 1.5 year back, they were in around $20 per pound, and right now they are above $50 per pound. So tell us what is going on with uranium prices, and where do you see prices going in the coming months? Where do you see demand coming from?
So, as you mentioned, uranium hit around $18 to $20 a few years ago, and at that particular price point, it was not economically feasible to mine it with any kind of return to your shareholders. So, many of the world's largest producers put their mines on care and maintenance or curtailed production to help reset the market. And that resetting of withholding supply from the market has helped to reset the market to a more balanced level. But our belief is that the price of uranium needs to go up significantly from here, because at $50 a pound, yes, it has had a material move in the last 2 to 3 years, but it's still not at a price point where it incents significant production that will be required to meet future needs. So, just to give you some context around this, last year, all of the nuclear power plants in the world required about 180 million pounds of uranium to function. And at the same time, there was only 130 million pounds of uranium actually produced out of the ground. So this shortfall has existed for a number of years, and we've largely been relying on secondary supply to fill that gap. Now, as the market has rebalanced itself, these secondary supplies are not readily available anymore, and that the only way you're going to close that supply gap is to reach incentive prices that are higher, so that different companies will turn back production. The United States, I think, is a really good example of a region in the world that requires 50 million pounds of uranium every year, and in 2021 produced a grand total of 21,000 pounds. And the reason for that is that many of the mines are closed, and they've been closed for several years now. So it is our belief that the incentive price has to go up to a level that, as the name suggests, incents the producer to either turn back on existing mines or actually build new ones, which are incredibly expensive right now, given all the inflation we're dealing with.
So you mentioned that Kazakhstan is one of the major producers of uranium, and Russia, we know, is also a major player in the global uranium production supply chain. So tell us about the impact of Russia-Ukraine war on uranium's supply chain, because we know that Kazakhstan is Russia's ally.
Yeah, and it's a very delicate situation right now that Kazakhstan is trying to play in terms of, not upsetting the West and not upsetting its neighbor to the north. So what I can tell you is that Russia is a small producer of uranium, So they produce about 15% of the world's uranium. And actually, most of that uranium is through joint ventures they have in Kazakhstan. So it's not mined on Russian soil. It's actually recovered from Kazakhstan. But where Russia has a very impactful in the nuclear supply chain is in the different stages of the fuel cycle. It is a little technical, but as uranium gets processed into its end fuel pellet, there's a few steps that have to happen. And Russia controls about 30% of one of the steps, which they call conversion. And the next step is called enrichment, and Russia controls about 40% of the global capacity in these two areas. So right now, there are no sanctions against Russian entities that are performing these services. But as you could imagine, if you were a utility in the United States or Europe, you're probably not too happy about taking delivery of those finished products from Russian entities right now. The sad reality is that there is no alternative. And the reason there is no alternative is that when we were going through a long bear market in uranium, many of the facilities in the United States closed or curtailed their operations significantly. So we essentially offshored those services to Russia because they were a very inexpensive provider. Now, as you can imagine, the US government is concerned that if something were to happen in terms of an escalation of tensions or if Russia withheld those services, there could be heightened risks for U.S. and Western-based utilities in terms of getting fuel from Russia, and that's obviously creating a lot of anxiety amongst the industry right now. So, as I said, there are no sanctions right now. But what we're seeing with this war day to day is that it's moving very quickly, and you just cannot predict how it will play out.
Right, this is a very uncertain situation. So let's talk about your two ETFs now. You offer a uranium miners ETF, ticker symbol URNM. This is listed in the US. And in Canada, you offer a physically backed uranium ETF. And in fact, this is the largest uranium ETF, the Sprott Physical Uranium Trust. Tell us about these two ETFs and also tell us about the difference in investing in physical uranium through your physical uranium trust, which tracks the spot prices, versus investing in uranium miners. Are these uranium miners like leverage plays on uranium? And are there enough number of uranium miners, pure play uranium miners that are liquid enough and can be included in the ETF?
So it's we've had tremendous investment response from investors right around the world in this thematic. And what we have found is that it's everything from individual investors to RIAs to family offices to very sophisticated institutions that we've spoken to over the last year and a half that are starting to piece together this uranium and nuclear energy story and saying, hey, this is really interesting to us. We see this big pivot happening across many different governments and markets, and we think there's a lot more to this story. So I'll start with on the physical side first, just because it's the bigger of the two funds. And the Sprott Physical Uranium Trust, it trades on the Toronto Stock Exchange in both US and Canadian dollars, but it also trades in the United States on the OTC Best Market, and the ticker is SRUUF. And this really is a simple product. It stores U3O8 uranium, so this is that yellow cake. We store it in essentially steel drums at three facilities around the world. We store it in Illinois. We store some in Canada, and we store some in France. These are the only licensed facilities in the Western world. And we've raised approximately $2 billion of capital in the last 13 months in the Uranium Trust, and that just reflects the very strong institutional interest we've seen. And for a lot of investors, they would like to just play the thematic by getting exposure to the underlying commodity. And why the trust has been so popular is that obviously it's not a commodity that lends itself to go and just to go and buy it on your own, like you could buy gold or silver or whatever, like we do with some of our other funds. So it's a product that obviously some institutions can go and buy on their own, but the average investor clearly cannot buy uranium. So it provides exposure to the spot market. The trust owns about 58 million pounds of U3O8, which, to put that into context, is enough uranium to power electricity at all the nuclear power plants in the United States. So 20% of all the electricity in the United States could be fueled with that uranium over a 1-year period. And we also have a mining related fund called the Sprott Uranium Miners ETF that trades on the New York Stock Exchange. The ticker is URNM. And that's a very different way to play the sector. These are companies that are either producing uranium, they are developing the mines of tomorrow, or they're exploring for the mines of tomorrow. So it's kind of a cross section of producers, developers, and explorers, as well as you get some exposure to vehicles like the Sprott Physical Uranium Trust. You get some exposure to the physical commodity through that vehicle. The stocks are obviously more volatile because they're stocks, because they're smaller cap stocks in many cases. And obviously, if you're an exploration company, you are still, you're still at a pre-cash flow revenue generation stage in all likelihood. So you're really playing this kind of optionality of future discovery. So it's more, these are more volatile and less liquid companies. But what we see is investors that want to gain the kind of the torque to the theme through the operating leverage and the optionality that these companies provide. We often find investors will invest in some ratio between the physical commodity and the mining stocks.
Excellent stuff. That's all we have time for today. John, thank you so much for joining us and sharing your insights. Really enjoyed the discussion.
Well, thanks for having me. Appreciate it.
So that was John Champaglia, CEO, Sprott Asset Management. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.